Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Scott Udall on the line. He is a
Sean Udall.
Sean
He's a
Udall.
tech stock strategist.
I'm looking at my 9 o'clock, and I looked at my 9. I'm sorry about that, Sean. Sean Udall, tech stock strategist, joining us on Benzinga's Pre-Market Prep. How you doing this morning?
I'm good, and don't worry about it. You and I have talked plenty of times, and I know that can happen. So no worries on my end.
Okay, what about the jobs number on Friday? Did you get up super early and take a look at the trading in the S&Ps? Came right back down to the bottom of the trading range that we've been talking about. Think that's going to hold up again today?
We'll see what happens. One of the things we talked about the last time I was on the show. I mean, I've probably been more bullish than most since I've been doing your broadcast. And last time I was on, I said, I'm kind of feeling my spidey sense is tingling pretty good correction vibes. That was, I don't know, six to 8 weeks ago now. So, here's how I kind of take it. The market can correct two ways: price and time. And the one thing we definitely have done, we've had a little bit of a price correction. We've kind of touched that 3 to 4% correction level a couple times. But what we've really done is we've had a really nice time correction. We've had a long sideways consolidation, which we have gone down. A lot more stocks have gone down than gone up the last 8 weeks. Things like the McClellan oscillator have come off from pretty elevated and overbought levels. And then what happens sometimes is the market just sort of gets stupid. And what I mean by that is I think the Friday's jobs number and the reaction to it is just sort of stupid, because anybody that thinks this economy is going to materially slow down and not print really strong sort of GDP numbers and jobs numbers and a lot of other stuff kind of the rest of the way through the year is probably barking up the wrong tree, as they have for I don't know, the last 2 or 3, 4 years. If anything, I'll sum it up by saying I think the risk is that we end up with a much stronger economy over the next year than people think about, much hotter inflation than people are worried about, and a situation where the Fed gets a little bit or a good bit behind the curve, and we end up getting evidence that says, man, the Fed probably should have raised rates a little more aggressively than they ended up doing, and maybe even the whole EU QE program was sort of unnecessary. And by the way, what I would point to is if you look at any of the European numbers, European auto sales are just flying. A lot of European economic numbers are really strengthening. And I'm trying to remember if I wrote something about this. I can't remember, but I did talk about Europe, and I talked about the fact that wouldn't it be funny if Europe basically did QE at a time that they basically don't need to do QE? And I think that's probably what's going to happen.
What are you seeing? You point out the European auto sales and what's going on in the European economy. What are you seeing over here that makes you so convinced that we're going to see some good numbers throughout the year as far as GDP and production? What are you seeing over here?
Well, I think it's the same thing. You can basically extrapolate. For about 4 or 5 years now, we tend to have kind of a first half, second half story, right? So first half, you do have some weather issues that's supposed to be seasonalized, but the funny thing is, it seems like the better we get with this computers and big data, now all the evidence we have, again, people just kind of get dumber with the numbers. And the bottom line is you always have kind of weird seasonal effects that hit in the winter that can kind of crimp growth. And then you kind of get more normal, just things tend to heat up in spring and summer and fall. And there's seasonal factors to it, but I think a lot of it is just that we still have a ton of pent-up stimulus. So there's basically two factors. For the last 3 years, I've been harping on the fact we have all this stimulus that does show up at least 2 or 3 quarters of the year. Maybe we don't print 4 or 5 or 6 or 7 quarters in a row of hot GDP, but in every single year, we definitely print 2 quarters of hot GDP, if not 3. We sort of have one. It's funny. We sort of have one bad quarter, and all the bears come out, and everybody comes out, and they basically say, "Oh, look, here's the problem. Here's Ben Bernanke's been stupid, and Janet Yellen has made a huge mistake, and the Fed is a bunch of lunatics, so they don't know what they're doing." And in fact, 3 quarters of the last few years, it kind of looks like the Fed has known what they're doing. But This year, there's another key catalyst, and it almost echoes to kind of my 1999 vibes. People forget that oil completely crashed in 1998. And people forget that in 1998, there was a huge global growth scare. There was a currency crisis into a period of time where the evidence actually pointed to an economy that was hot and was probably going to get hotter. And so then what happened? We had these couple little mini crisis issues. All the central banks back then, they actually eased. They were already easy, and they eased. And then we ended up with 99. Well, you're kind of getting the same thing today, but, not everything's the same. But oil crashed again. That's going to be a huge stimulative effect. The Fed and the EU Central Bank probably should have started raising rates a year ago, and they haven't done that yet. So they haven't necessarily eased, but they've stayed very, very easy at a time they probably should have been at least putting some bullets back into the gun, is the term I like to use. So, instead of tightening a little bit, they basically stayed at record easing. So all that stimulus is still out there and is going to heat up again. And I think part of here's a funny thing. If you live in 2/3 of the United States, you see a ton of evidence all around you of how strong the economy is. But if you live in New York City, or if you live in a couple pockets of the East Coast or certain areas of the country, it doesn't feel that hot. I mean, try to find an apartment in San Francisco, right? Try to find a house to rent in San Diego and LA. Look at housing prices in Phoenix and Las Vegas and the whole West Coast, and probably all the way over to as far over as Alabama, except for the state of Texas, which is being crushed by the price of oil. So anyway, there's all these factors. I mean, but that's really the only thing that's that weak right now is oil in the energy markets. That's about it. Everything else is pretty strong, and I think there's plenty of evidence for it. So again, I think the risk is to the upside, and a mistake being made that the Fed actually didn't tighten and the EU kind of eased at a time when they should have either stand pat or, should have tightened. So we could get on and we could talk macro a lot, but, but by the way, so I'll transition into where could earnings be good versus where might not they be good. I think most of the areas I cover, which is high growth tech, big data, cloud, security, certain internet names, I think they're going to report very, very strongly, just like they did last quarter. While the energy space, kind of the old economy stocks, maybe companies that are being pressured by the strong U.S. dollar, will probably report just like they did last quarter, which wasn't so good.
Wow, what a great historical perspective on things. So before we go to the old standbys here, is there any new issues on your radar?
Yeah, there's a couple I think we're talking about. I think Arista Networks, which we may have talked about on the show once or twice. You and I have corresponded on it a few times. And the other one that might be interesting would be TrueCar. So you pick where we want to start.
Let's start with Arista Networks here. Nice pullback here. I know you were chomping at the bit, thinking of shortening it into that big rally, but it was kind of parabolic here. But now it's pulled back here, not quite a 50% retracement. Give us your take on ANET.
You just hit it. So first of all, they were one of the two. Probably one of the three best earnings reports of not just the last quarter, the last 2 quarters. They've got this Cisco lawsuit kind of hanging over their head. But, I mean, this stock has been a trader's dream. If it basically goes down to the low 60s or under 60, it's been a long all day long. And then, if it pops like $15, it just doesn't hold. I mean, that 73, 74 level is sort of, you either sell everything you have or flat out go short on it, right? Well, now, so there again, it's had about 6 to 8 weeks of consolidation, but it has corrected by time and price. And you just hit the nail on the head. The 50%, the FIBO level is, I mean, we're pretty close to it right now. What is that officially? It's probably 65. So we're pretty close to that 50% FIBO retracement level. That would be like ideal, even a little lower. I'm not so sure it's going to hit it. It basically dropped the other day $3 on the CFO leaving. And I mean, here again, let's just talk about how stupid things get. A CFO leaving for legitimate reasons is one of the dumbest reasons in the world to sell a stock, especially one that's pulled back from 74 to sort of, in fact, the stock had sort of just started bouncing, and then that announcement came out and they took another 3 points out of it. So that's definitely going to be a name that's going to be on my long radar, especially if we get more weakness.
Okay, and what about you said TrueCar, TRUE?
Yeah. TRUE. So this is another one that, So it's sort of interesting. They didn't have a great quarter, but it wasn't terrible. But this is a typical kind of name that happens. People, they get excited about it. They probably get a little over enthused. There was a 23.5, 24 level. People were talking breakout to the upside on it. Well, the breakout failed. The earnings weren't terrible, but they weren't good. And here we have a stock that was 24 again about 8 weeks ago, and right now it's about $16. So it's not a name I love, but it's a name I now. Put it this way: under 18, I start getting interesting. At 16, I start getting real interested. Another point or two, I would probably leg into this decently. But I'm kind of interested in this right now on the long side. Again, it's a good retracement level. It's a good technical level. It's corrected by time and price. It's not like anything's been terrible. They just didn't blow it out. And I think a lot of people got caught on the wrong side of the trade. That people were chasing it sort of above 22.50, above 23. There was quite a bit of volume back then, and then it's basically failed. And anybody that chased that momentum was caught holding the bag. So, I mean, that's kind of how you have to play this market, by the way, right now. We tend not to get big breakouts to the upside. They tend to fail. At the same time, we tend not to get big breakdowns to the downside, and people that chase those hard, they tend to fail. And we're sort of stuck in this trading range, which I think will break out of the trading range around the time Apple reports earnings. Probably a few days before it might start. If Apple's good and Google's good and a couple other high-growth companies are strong, I think that's probably when we re-break out to the upside on this sort of current phase.
What do they do? What's TrueCar do?
Sorry about that. TrueCar does a deal where, let's say, okay, you're looking for a new car, right? And maybe you don't like shopping and maybe you don't like haggling. You literally can go to TrueCar. You can get an estimate. It's a competitive estimate, and you bring it in, and basically it's sort of a price advantage program. But it kind of reduces the haggling. It gives you a competitive price. They say they can save you quite a bit of money on a new car purchase. I haven't not used the service myself, but I look at how many people do use it, and their growth numbers are really good. I think it basically kind of helps in just the ease of buying a new car and getting a competitive price. The other thing that happens, what I like, they get paid a pretty decent amount of money. So my understanding, I don't know the exact dollar figure, but every time basically somebody comes into a dealership, does a deal, and it's based on a TrueCar quote or estimate, basically TrueCar gets paid by probably the combination of the dealership and the auto company. And it's sort of like a nice software sort of margin story, because it doesn't cost the company a ton of money. You get thousands of people helping TrueCar get paid whatever it is, $200 or $300 a transaction. That kind of money adds up very, very quickly. And we'll see what happens. I mean, I love to haggle. I love to go into a car dealership. Now, I don't like I'm not going to sit there for 2 hours. I'll do the whole thing where I'll give you my price, we'll haggle, I'll walk away. You can call me back with the price that you're going to give me. But the bottom line, a lot of people don't really like to negotiate for a car purchase. By the way, that's something I've never understood, because I think it's one of the funnest things you can do. But a lot of people hate doing that, and TrueCar kind of is one of these systems or one of these services that eases that. But it's just a lot of it's just in the numbers, Joel. If you just look at how good the company has grown, their transaction volume, their sales growth, all that kind of stuff. It's a pretty nice growth story. It's not that expensive anymore. Again, it was kind of pricey at 24. Hey, $8 off 24. That's a pretty good correction on a mid to small cap name.
No, I like that. I'll keep an eye on that as well. Coming out of the chat, would you consider Imax as a tech play? IMAX.
I don't really. Yeah, some people have in the past. I don't really know that. I mean, I know what they do. It doesn't really fit my parameters. I would almost call it kind of a. It's really just a kind of almost just a normal media play in sort of my world. So, yeah, I probably wouldn't call it much of a technology play. I don't really know that company that well. I mean, it's been a decent growth story over time, but it's not in my focus list. Let's say it's not a Twitter.
Okay, let's go to Twitter then. Flirting with 50, man. This thing is a tease. I know we got excited when it broke out that day over 50. Put a double top in, get a downgrade, you come back down. Are you just looking for this thing just to gather some momentum here, build a base at 50 and launch to 55?
Probably. I mean, if you're a pure technician, probably the most bullish thing about Twitter is the proximity to the 52-week high now. So, the 52-week high is effectively 56. It's 55.99. But I mean, what you tell me what's going to happen when this thing breaks 56? I mean, it doesn't take a rocket scientist to figure out that there's a rocket launch coming. So at the same time, they do have to deliver. I would not be a bit surprised. By the way, so what could happen to Twitter could happen to about everything that delivers a stunning report this quarter. I wouldn't be a bit surprised if, what do we call it, the machines, the algos, the algorithmic traders, the market makers, whoever, whoever you want to blame. You shouldn't blame anybody. You should only blame, hold yourself accountable for good trades and good investments. But I wouldn't be surprised if a lot of these names are sort of contained or held back, or even they try to shake out the weak hands before they report. So there could be a slight down bias to kind of names before they report. But I think Twitter is going to deliver another very, very strong earnings report. By the way, this Periscope deal is really interesting. I don't think Periscope will drive revenue and earnings numbers on Twitter for probably at least 2 quarters. But the Periscope has this funny deal. It's Twitter's already a viral sort of area, right? I mean, it's a viral app in its own right. But to the degree that Twitter can create viral use cases and viral apps within the platform, that will only serve to drive that much more activity and serve to drive the thing that has haunted it, which is monthly active users, MAUs. So if Periscope is the thing that gets people excited and gets people off the fence and start looking at Twitter, that could be the thing that launches the stock. Even though I don't think it's going to affect numbers, the numbers are already good enough. Again, if I jokingly talk about if Twitter were a biotech, where would it be priced? And if Twitter was Regeneron, it'd be $130 to $144 stock, just on similar metrics. So it's delivering plenty of growth. In fact, it's delivering 2, 3, 4x the growth of these high growth biotech stocks, and it sells at a 50% discount to most of these high growth biotech stocks. So the numbers are there. You just need a catalyst for people to get excited about the stock again. But yeah, I think it's going to eventually break 56. I think it's going to set new all-time highs. I think I said not too long ago I thought it was $100 to $150 stock longer term. So I just got to go through the motions, and that the algos will do what they do, and the market makers will do what they do, and they'll try to shake weak hands out of it. But I think they're going to deliver a strong number. By the way, I would be a bit surprised if Apple does that. I would be surprised if Splunk does that. I would be surprised if Tableau Software does that. So I think that's kind of my playbook, is sort of staying cautious and waiting for entry points ahead of earnings, looking at common, looking at some calls, looking at call spreads. But if I do see notable weakness before earnings reports in my favorite companies, I am not going to be shy to get into those names.
Okay, 2 more before we let you go. One, we've been talking a lot about GoPro, all those analyst upgrades, tried to get it over 44, had a little bit of fake out, then you had the breakdown here. Battling back today, give us your take on GoPro.
Yeah. Well, I mean, if you liked the stock when I did and you embraced the calamity, it was a beautiful trade. I mean, really, if you bought it at 40 or below, and especially if you caught some size under 40, I mean, as you know, levered 10% trades can work really, really well. So if you're using any kind of options or even just a big common position for a short period of time, I mean, 10% trades is a 50% trade, right?
Yep.
So if you caught that trade, it's worked really well. I do think it's working. It's consolidating. The chart actually looks pretty good. I mean, if you can even put up a daily chart, you've had fairly bullish action for the whole month of March. A month, by the way, which almost everything else in the high growth space had corrective activity. So, what's interesting about GoPro is, well, everybody else was sort of going from a hot stock to an overbought stock and then correcting. GoPro was actually doing the opposite. So in the month of March, GoPro actually put in a lot of relative strength. But, hey, the stock did go up six points off of lows. It's sort of natural that they'd have some selling. I do think there was a little bit of news. By the way, I think maybe some people were worried or maybe tried to put 2 and 2 together and said, hey, could this Periscope thing be something that hurts GoPro. I don't think it is because I think it's a totally different application. But it is interesting that almost to the day that Periscope talk was super hot, that's when you got that ugly day on GoPro where they had that $2.50 to $3 correction. So it's kind of interesting. Again, the market will find ways. I mean, once the stock is bounced from 38 to 44, it doesn't take much to give it a kind of a sharp little correction. But no, I still like the stock. I still see, I mean, minimum something in the low to mid 50s, minimum. And it could go quite a bit higher. I mean, this is another one that's going to have to deliver on the earnings numbers. But they had a really good report last quarter. They just got hung up on a few other things.
Yeah,
so,
the insider
but yeah, now technically, I mean, if this thing breaks 44 to the upside, the next move is right about 50-51.
Okay, we've been on the line with Sean Udall, the tech stock strategist. He joins us on Benzinga's pre-market prep, giving us a great outlook on the market. And if we would just been buying S&P futures when you were given this bullish scenario here, we'd be able to call it a week or a month here. We've had an explosive rally off the open. So, Sean, thanks a lot for joining us, and we hope to speak to you again soon.